Welcome to lesson 2, where we will see the differences between spot, perpetual, centralized exchange, decentralized exchange, and order types. First, let's have a quick distinction between an investor and a trader. An investor holds coins in their own wallet for a long period of time. A trader leaves money on an exchange and moves in and out of positions frequently to capture short-term price moves. Everything we are covering today is built for the trader, not the investor. There are two ways to be exposed to crypto as a trader: spot and perpetual futures, also known as perps. Understanding the difference is essential. Spot trading is simple. You exchange your dollars for Bitcoin. You now own that Bitcoin. Full ownership. No contracts, no expiration. If Bitcoin goes up, your Bitcoin is worth more. If Bitcoin goes down, then your Bitcoin is worth less. That's it. Perpetual futures are different. You do not actually own the Bitcoin. Instead, you enter into a contract with another trader. You say, I want to buy, and they say, I want to sell. And the contract lets you speculate on the price without even owning the asset. Think of it like a bet. You bet that the price will go up or the price will go down. And if it goes other way of your bet, then you lose your money. The reason perps exist is because of three reasons. First, leverage. You can open a position using only a fraction of the full price. 1% down in capital can give you 10% exposure. That is powerful, but at the same time, dangerous. That's why risk management is very important when trading perps. Second is liquidity. There are only 21 million Bitcoin in total, but there are billions and billions of dollars of Bitcoin perpetual contracts being traded every day. More liquidity means tighter spreads, better feels, and a bigger market for everyone. And third is flexibility. You can go short, bet the price will go down. It's very easy on perps and anyone can do it. On spot, it's much harder. If you want to buy crypto and hold it long term, use spot and move it to your own wallet. If you want to trade crypto, enter, exit, capture short and mid-term moves, use perps. Perpetual futures requires more amount of time spent, more time analysis, fine tuning your systems, backtesting, and so on. Now, let's see where you can actually trade. There are two kinds of exchanges and the different methods. Centralized exchanges are run by a company. You deposit your money, they hold it, and you trade on their platform. Some of the biggest ones are Binance, Bybit, BitMEX, OKX, and KuCoin. All of them offer future trading. Personally, I trade on Bybit. This is the trading interface of Bybit where you can trade perps. Bybit has great liquidity, solid interface, competitive fees, and the futures market is deep enough for serious size. If you want to try Bybit, I have an affiliate link in the description and you get up to 30,000 in rewards plus 20 USDT free on sign up. Full disclosure, it is an affiliate link, but I use the platform myself. Important to know, when your coins are on a centralized exchange, they are not fully in your control. This is called counterparty risk. Do not keep all your money on one exchange. Spread it out. Only keep trading capital on the platform. The rest stays in your own wallet. Decentralized exchanges work differently. You connect your self-custody wallet directly to the platform. You stay in control of your funds the entire time. The two biggest perpetuals decentralized exchanges right now are Hyperliquid and GMX. This is Hyperliquid trading interface, which is the market leader by far. Higher open interest, higher volume, deeper liquidity, and lower fees. If you cannot access a centralized exchange in your country, or you just prefer on-chain trading, Hyperliquid is where you want to be. This is not a financial advice. You are responsible for your own capital and the laws according to your country. So research and do what's best for you. By the way, if you are finding this useful, please subscribe. Every lesson builds on the last. Now, order types. When you open your exchange interface to place a trade, you will see a bunch of order types. Most of them you will never need. Let me show you the ones that actually matter. A market order fills immediately at the current price. You click buy and you get filled right now. A limit order fills at a specific price in the future. You say, I want to buy Bitcoin at 70K, and your order sits there until the market reaches the price. This is demo account, fake money. So first we add our stop loss, 65,000, limit order, 70,000. We add our quantity, let's say 1% of our portfolio, around 10K. Take profit 80,000. We are happy about this order and we say long. Confirm. And we see that the limit order was added at 70K. So if price of BTC drops to 70K, then this will trigger. And also the stop loss will instantly trigger as we added it to 65,000 and the take profit to 80K. And we will, of course, also pay less fees. So there are two types of traders in every market, the makers and the takers. When you use a limit order, you are a maker. You add liquidity to the order book. When you use a market order, you are a taker. You remove liquidity by filling someone else's limit order. And this matters because of fees. Exchanges charges takers more than makers. Sometimes 2 or 3 times more. In Bybit, for a taker, 0.055%, and for maker 0.02%, more than 2x. A stop market order is your stop loss. It protects you when the trade goes against you. You set a price, and when the market hits it, your position closes at market price. Rule of thumb, always use a stop market order, not a stop limit order. A stop market order is guaranteed to execute. A stop limit order is not. During a fast crash, the price can blow right through your stop limit and keep going, and you get liquidated. Do not use stop limits ever, unless you are very advanced and you know exactly what you're doing. A take profit order sets a price where you exit with profit. You define it when you enter the trade. Now, a trailing stop follows the price as it moves in your favor. Let us say you are long and Bitcoin is pumping. You do not know when to take the profit. You set a trailing stop 5% below, and as the price goes up, the stop moves with it. If the price drops back 5%, you exit and lock in your gain. Great tool for riding the trends. Reduce only is a setting you check on your order. Always set it on your stop losses, and here is why it saved many traders. Let's say you are short on 1 Bitcoin and you accidentally set your stop loss for 2 Bitcoin. A reduce only order will only close your existing position. It cannot open a new trade in the opposite direction. Use it every time. Here is the reduce only on Bybit. Take profit, stop loss. Always set your stop loss before open the trade so you can see if you are wrong. If your trade does not succeed, how much you lose. This is proper risk management. One last thing, most exchanges have a testnet mode, a demo version where you can practice with fake money. And Bybit, luckily, You go on your profile and then you go demo trading. You cannot fake money and trade with fake money. So you don't lose your money before you learn the platform. Start trading with 100K demo assets. You accept. Now we have 100K available, and you can open positions and trade with demo and fake money. So to recap, first, spot if you want to own, perps if you want to trade short term. Second, centralized exchange for liquidity and ease, and decentralized exchange for self custody. Third, market for speed but not the best price and higher fees, and limit order for price and less fees. Thank you for watching. Next lesson will be how to trade on a crypto exchange.